Hey, everybody. Welcome. Thanks a lot for joining. My name is Matthew. Today, we're going to continue our analysis of the United States money supply, and we're going to move on to the metric called M3. And this is a bit of a challenge because the Central Bank of the United States hasn't published this metric since 2006. So here we are, looking at the broadest metric, the broadest money supply that the United States has ever published in recent memory. They have published a money supply that was even broader than this. It was called L, but that wasn't really used in the last few decades. The broadest money supply that was used in the last few decades was called M3. And as I mentioned, the Federal Reserve, the Central Bank of the United States, the institution that is in charge of getting a handle and a control on the nation's money supply of dollars, has not published it since February of 2006. And as I've said throughout most of these money supply videos, again, this is a cumulative stack. When you look at all the money that is on the client side or consumer side, the consumer-facing accounts of both people, retail, and institutions in the United States or in any country. It's this cumulative numbering system which Paul Volcker and many Fed officials in the 50s and the 60s started to define in this way. And that is very simply, again, M0 is supposedly the most liquid money supply of the United States. That includes simply base money, but it's base money that is in cash and coin form and is outside of bank vaults. So it's a very specific portion of basic money. Next is M1. M1 is M0 plus what's traditionally called sight deposits, or if you're listening in the West, you might know this as checkable deposits or demand deposits. Typically, when you think about a bank account, it's this. So M1 is M0 plus demand deposits. And then M2 is where you get into the supposedly less liquid monetary retail instruments. M2 is M1 plus less liquid type retail monetary instruments. And M3 is M2 plus less liquid type institutional monetary instruments. But again, I hasten to say, even though it's typically thought of because you have savings deposits, time deposits where you can't easily withdraw your deposits from a bank or from a fund, it's typically thought of these broader money supplies, M2 and M3, as being less liquid. That is not always the case, and it's certainly not the case here in M3. A better definition of these broader money supplies are simply that these are less regulated money supplies of the United States. M0, of course, is very regulated. This is the actual cash that the central bank itself prints and issues, or in the United States' case, the Treasury also mints and issues the coins. And then as you go up this stack here, really what's happening is you're looking at not necessarily less liquid instruments, but less regulated instruments. Now, it's extremely important to understand a nation's money supply on a macro level, not just to understand the value of the currency itself, but to understand what's going on. If there might be bubbles developing, excess liquidity developing, perhaps issues with the economy that it might be overheating in certain places. It's extremely important to get a handle and an understanding of a nation's money supply. And I am certainly not the first person to say this. I will not be the last, that it was extremely unfortunate that the Central Bank of the United States, the Federal Reserve, after being a pioneer in describing these different types of monetary curves or M curves, different types of fiduciary money, fiduciary media, different types of bank accounts, trying to classify them, categorize them. I already told you that in 2020, they stopped publishing M1 in its traditional historical backwards compatible form. That was not the first time. In 2006, And of course, they stopped publishing L even before that, the broadest L money supply. But M3 was certainly a money supply that was used then by many economists, and I will have quotes for you in the next video. But it's used by literally every other central bank in every other nation around the world. And they stopped publishing an M3 money supply in February and March of 2006. So here it is. And this causes a challenge for us, but it's certainly not an insurmountable challenge. A lot of data that is a part of the old M3 money supply does exist. And so let's dissect this. And we're going to do this very methodically, very slowly over the next few videos, just to show you each component of M3. And very, very specifically here, just like we did with M2, this is, if you look at the subtitle, this is the non-M2 portion of M3. Remember, these M curves, these monetary supply curves, are cumulative. So M1 includes M0, M2 includes M1, M3, of course, includes M2. But we've already gone through the lower level curve. So now we're just going to look at the non-M2 portion of M3. I know it's a mouthful. I know if you haven't any experience with understanding these curves, it might be hard to understand, but I'm going to try to do it as methodically and as clearly as possible, and hopefully I succeed for you. So, 2 items to start with here. The first that you'll probably notice is the big dark green shaded area. This goes from the beginning of the chart all the way to the end. What is that? That is large time deposits as calculated by the Fed. These are time deposits that have in excess of $100,000 in account balance value. And typically this is understood to mean institutional or corporate type deposits, but of course, private sole individuals can have large time deposits that are over that amount as well. And what is a time deposit? We talked about it a little bit in the M2 videos, of course. It's simply a deposit that you lend your money to the bank explicitly for a certain amount of time, whereas the sight deposit, demand deposit, even a savings deposit in many cases, is not limited to a certain time window. Time deposits have an explicit window of withdrawal that is a certain type of bank account where you are literally lending your money, as you do with all type deposits, but this is very explicit, where you are lending your money for 1, 2, 3, 6, 12 months, even longer, with a very explicit window that if you choose to withdraw this money before that time, you will be penalized and you will not get the entire amount of interest that you have negotiated with the bank beforehand. That is a time deposit. And so typically time deposits, whether you're talking about the USA or Canada or any central bank, these are of course in M2 or M3. And many countries, as far as I've seen with my research, they're not even in M2, they're in M3, regardless of size, regardless of the size of the deposit. But of course, this varies by nation. The United States has chosen to split this up by the $100,000 threshold. So any time deposit that is under $100,000 is a small time deposit, and any deposit that is over $100,000 is a large time deposit. And then the second indicator that I'm showing here, delineated by this black line, is M3. Very specifically the non-M2 portion of M3. So this is where we get into M3 money. Remember, this is cumulative, so if I showed you a chart of total M3, it would be a different value, because remember, that includes M2 and every other M below it. This is just the non-M2, M1, M0 portion of M3. This is pure M3 money. That's denoted here by the black line. And we see that it was $2.2 billion in January of 1959 when the Fed sort of, in the modern era, started to publish these money supplies. And you can see it grows all the way until it was discontinued here in February of 2006, $3.5 trillion, or $3,560 billion. $3,500 billion, or $3.56 trillion of non-M2, M3 money. So even without understanding anything else, you can see that the large time deposit portion, especially if I zoom in here, the large time deposit component of non-M2, M3 money is huge. It's the biggest component. You can see it's just clear, even if you zoom in even more. In the 60s here, this is clearly the vast majority in the early times of calculating these money supplies of M3, non-M2, M3 money is the large time deposit. Basically the corporate or the non-retail, non-private person time deposit. Of course, there are very wealthy individuals that will have time deposits that are over $100,000. This delineation, this threshold that the Federal Reserve has set. But typically you can think of, that's why I have the little factory there. This is money that is institutional money that is tied up. This is, people in the hardworking economy that want to earn some interest on their excess liquidity. That is where this money sits. That is where this money sits. And notice this does fit the traditional definition of a less liquid deposit, of course, because it's the time deposit. They have the money tied up for a certain period of time and they can't spend it. What does the bank do with that money? Of course, they lend it themselves in other projects in an attempt to earn interest, which is fine. That's how capitalism works. It's not a problem. But again, the Federal Reserve stopped publishing this in 2006. Why? We'll discuss in the next video. It's unfortunate. Nonetheless, they stopped. Of course, you see that the large time deposit value continues on. And thankfully, the Federal Reserve, in one way, shape, or form, it's not so easy to collect this data anymore. You have to sort of derive it from other data in certain ways. It's still calculated. And we can still get a sense of where large time deposits have been since the Federal Reserve ceased publishing the M3 money supply. And we see it increased quite rapidly here throughout this ceasing of publication until the global financial crisis. After the global financial crisis, the Federal Reserve stepped in, Ben Bernanke, with massive liquidity and bond buying and corporate bailouts, and interest rates went from near 5, 6, 7% in certain cases, all the way down to near 0% in a matter of months. And interestingly, you can see time deposits react to that. You see that they went flat to even down to basically flat, a few bumps here and there. But even now, the large time deposit balance as of December 31st, 2022, $1.6 trillion, that is lower than the September 2008 time deposit balance of $2.1 trillion of large or institutional type time deposits. Now, there is one more type of money that is included in M3 or non-M2, M3 money that the Federal Reserve still publishes to this day, and that is institutional money market funds. I'm going to draw that curve now. And again, this is stacked, as it says in the subtitle. So you see these are subsets here of the total, which is the black line. And they still publish this data one way or another. You have to kind of derive it again. This one's only quarterly. And you can see where they went. And let's even take away large time deposits just so we can see this on its own. We see here back in the 60s, this is actually rounds to basically zero. I think it was, in fact, zero during the early years. Starts to get above or rounding to $1 billion, not even in the 70s. In the mid-70s. In the mid-70s, starts to round to $1 billion and more. And we see it grow. Grows actually very quick between the ceasing of M3, the ceasing of publication of M3 in February 2006 until the global financial crisis, similar to time deposits, large time deposits. And then again, actually flattens out here after the financial crisis, and then has grown rapidly in the COVID years. Now, we discussed what a money market fund is in the M2 video, the non-M1, M2 video. Just very quickly again, this is a non-bank account, FDIC insured type of instrument, but it is an instrument run by different funds, money market mutual funds, money market funds, they call it. And often when you go into cash in your brokerage account, you're going into a money market mutual fund. You're not going into a bank deposit account. You're not even going into an insured account or savings account. You're certainly not going into physical dollars when you say, I sold my Amazon stock and I went into cash. Typically what it is you're going into a money market mutual fund that is managed by a third-party fund, either on behalf of a broker or by the broker themselves. That's how it works in the United States system. That is a money market mutual fund. And again, here, M3 money, this is institutional type money, always not retail. So institutional type money market funds. And here we again break this sort of traditional definition of M3 being less liquid money, because institutional money market funds are certainly liquid. Yeah, they might be tied up into government bonds to earn an interest, so on and so forth, but those are very liquid themselves. They could sell those bonds, they could buy another type of asset, so on and so forth. It certainly isn't the case that institutional money tied up in a money market fund, regardless of the policies of those fund, is not liquid. This is certainly liquid money, and you can see that it bounces around accordingly, depending on the market. And we are at all-time highs here, all-time highs. So unlike large time deposits, right, when we had very low interest rate environments, we see a lot of cash that has arrived into the money market mutual fund industry or market. So this is it for the first video on non-M2, M3. I just want to show you these two. Let's put large time deposits back. Now we can see them together. We can see that certainly these two instruments are the largest component of non-M2, M3. Largest component, again, we had $3,500 billion or $3.56 trillion in non-M3, M2 when the Fed ceased publishing this data, very unfortunately. And if you add up the 1.4 trillion of large time deposits and the 1.1 trillion of money market mutual funds at the time, you will see that's about 70% of the total, 70% of the total. And I want to put back now the right axis, which this actually goes back to what I was saying before. It's just the proportion of large time deposits. I could have put the proportion of both, but let's even take out institutional again just to look at this. You see, as I've said before, zooming in here, the 60s, 70s, large time deposits were the vast majority of M3 money, non-M2, M3 money. 90+% here in the 60s, in the late 60s. Had a dip here in the 70s. I'm not completely sure why that is. I haven't looked into it, but you know, we had the Nixon shock here, the end of Bretton Woods. For some reason, liquidity left this broader monetary instrument. It came back, though, relatively soon after. The final remnants of the gold standard ended here in August 1971, and we continue our ratio down here of institutional large time deposit balances falling as a proportion of the total to where we're at 90% plus in the 60s, and then now in 2006, or not now in 2006, but when the Fed ceased publishing in 2006, they were only 40% of the pie, 40% of the total. And again, if we put back the institutional money market funds, you would have about 70% of the pie from those two instruments. So pretty interesting to see, even though the Fed did a great disservice to the economy, to people that are trying to understand this stuff by ceasing to collect this data and publish this data, we can still back into some numbers, and I will continue to do that over the next few videos. So please stay tuned for that, and thanks a lot for watching.